I want to tell you all why the Fed is trapped. And I know that some of you will agree. I hope those of you who don't agree will be persuaded. The Fed is trapped, though, and that is the key to me for the gold and silver markets. And the gold and silver markets are the key to what you see out there, the junior mining share market. One of the points I make to people is there is no such thing as a rollicking bull market in zinc or copper or anything else absent a bull market environment in gold and silver. That's what brings the investors into the sector. That's what gets everybody's juices going. And then it spreads out to the other asset classes, other metals. And that's what gets everything going and all the excitement going. So we need gold and silver to move, and they will eventually because, again, the Fed is trapped. So what's happening right now is that the Fed is attempting to tighten monetary policy. That's not news to anyone. But what is news to a lot of people is that this will be impossible for two very powerful reasons. First, addicted markets. Many years of ultra-easy policies have created a towering financial house of cards. Markets, and this is important, are not just addicted to easy money, they're addicted to ever easier money. This means the Fed has to do more than it did last time because the patient, the addict, has developed a tolerance for the drug and needs more to get the same effect. That's why post-COVID, they did in 4 to 5 days, it took them 4 to 5 years post-2008 great financial crisis. Easy money builds bubbles. Here's a chart of the Fed assets against the S&P 500. The current correlation is 92% in change. It is always in the high 90s for that correlation, in the 90s to 95% on that correlation. There is no doubt that easy money builds bubbles. It's done that in the stock market, and by design. Remember, this is what the Fed wanted to do, has wanted to do. They want to build up financial assets because that basically protects their constituency. Home prices versus Fed assets. Again, it's undeniable. You can see the bubble that's been built by the increase in Fed assets, which is the blue line, and median sale price for new homes, which is the red line. Of course, there will be a correction in this, as there has been a correction in equities. So what I'd like to show with this chart is that this is the continuation of a trend that goes back at least 40 years, at least to the early 1980s, post-Volcker. And what you see here is that in every instance where the economy, and this is a chart of the Fed funds rate, by the way, whenever there's been any kind of slowdown in the economy, even just a hiccup, even the barest excuse, the Fed has had one prescription every time. It's loosened monetary policy. It's lowered rates. As you can see, this was a stair-step pattern going back to 1980, where you have ever lower, I knew I was going to do that, ever lower lows in the Fed funds rate. And as you can also see, is when they tried to normalize rates, they never got even back to the midpoint of the previous range before, again, they had to lower rates again. So it's a stair-step pattern. The stairs go from the second story right down to the basement. The question that this obviously implies or asks or begs is, will they go to negative nominal rates? Possible. Who knows? The trend here shows that they will eventually. So when you look at what they're going to do to beat what they did last time, negative nominal rates is one tool that's left in their toolbox. Now, here's the other key. Here's the other powerful reason. Low rates also encourage the buildup of unmanageable debt. Years of managing interest rates ever lower in response to economic slowdowns, real or imagined, has fostered the creation of towering debt loads. This is the national debt as of a few days ago. It's gone up about $100 billion over the past month. This is about 3 times the level that it was post-2008. So even, and I'll get to this in a minute, the prescriptions that they did, or the attempts at normalization in 2008, post-2008, which actually did not occur till 2015, had tremendous repercussions. Now the federal debt is 3 times as large. Those repercussions have gotten only much larger. The Fed, because of this debt, is running into a brick wall. This is why they will have to reverse course. Today's debt load prevents the Fed from normalizing rates or anything close to it, and let's see why. Here's a chart of federal debt and federal interest expense. Now, people will tell you, and I've wondered for many years, what's the actual interest rate on the federal debt? Nobody knows. It's a moving target, so many different maturities. Well, you can actually take the Fed's data series on Fed interest expense and simply divide it by the federal debt, and you get a simple interest rate. I'll show you that in a minute. But first, let's look at federal debt and federal interest expense. Federal debt is the red line, and you can see that interest expense goes up and down, rising generally, but goes up and down and has some pretty significant fluctuations. Let's drill in on some of these. In 2015, December of 2015, the Fed had its first rate hike. And here we see, again, in red, federal debt, and then we have interest expense. Now, you'll see the federal debt rose at a fairly steady rate. Now, the Fed started raising rates at the blinding rate of 1/4 point a year for the first 2 years, a year. So they only got to between 1/4 and 0.5% on the Fed funds rate. But look at the difference in the interest expense. It was tremendous. It went from some $460 billion to nearly $600 billion in a flash. That's because the debt is so large that the leverage on even a small increase in interest rates yields a very large bottom line cost in interest expense. Now let's zoom in on this a little bit more. Actually, we're not going to zoom in. That was our zoom in. I apologize. I mentioned that I've calculated an effective simple interest rate on the federal debt. And I did this by taking the interest expense and simply dividing it by the federal debt on a quarterly basis. This is a result of that. This chart goes back to 2000. And I skipped the 80s to the 2000s because there was basically just too much information. But generally, you'll see that the gap between the Fed funds rate, which is in red, and the interest rate, the effective interest rate, is generally between 2 to 4%. So let's make some assumptions. Again, remember, these days, the federal debt is about 3 times where it was at the 2008 financial crisis. Let's assume that the effective interest rate will adjust to only 2% above the Fed funds rate. Let's also assume that the debt owned by the public right now is $25 trillion, because any debt that the government, any interest payments, the debt pays itself, the government pays itself net out. So only $25 trillion debt owned by the public, 4% effective costs on the federal debt, 4% effective rate, interest rate on federal debt. That yields $1 trillion in interest payments on the federal debt every year. My point is this is a simple round number that I think will awaken a political element in the U.S. where they will start talking about why are we paying this federal debt? Why are we paying this to fat cat hedge funds, deep-pocketed investors, Wall Street billionaires, and China, when we could be having universal basic income, forgiving student loans, et cetera, et cetera. Why are we paying $1 trillion a year into air? And I think once those conversations start, I think it's going to be very destructive for the value of the dollar. Implications of this. And whatever level, I'm saying $1 trillion seems like a big, even number, but at whatever level, the interest cost, bottom line cost of servicing the federal debt is going to soar very quickly. Because remember, the Fed right now is hiking rates at the rate of 0.5% a meeting. So they're doing what would have been 2 years of rate hikes previously in a single meeting right now. Everything is happening more quickly these days. Everything is happening more quickly. So they are already at a level or an increase in the Fed funds rate that took them 2 years post-2008 when they started hiking in 2015. So the Fed will not be able to significantly affect inflation and will in fact need inflation to depreciate the debt load. The Fed will have to turn back from its rate hike campaign either due to market pressure or the debt service brick wall. The market pressure, of course, comes in those 800,000 point drops in the Dow that we've seen a number of. I mean, it really is amazing how many of those that we've seen over the past few months. The one thing that I've seen is that in each instance, we've had these liquidity vacuums where everything gets sold to meet margin calls. And gold and silver, precious metals get sold as well. At this point, not that many hedge funds even own gold and silver anymore, so they don't have any gold to sell to meet margin calls. And they're probably not very highly margined to begin with. So the effect on gold has been less and less on every big downdraft in the stock market. And as we saw Friday, the algos hit it once the yield, 10-year yield soared, once the dollar soared, post the CPI number. The algos hit the market, gold fell $20, but then big buyers came in, bought that dip, and we ended up $25 or so. So that's highly encouraging. What it all means is that metals and mining will rally as the Fed continues to hike rates. Once Powell and company are forced to retreat, metals, mining, and all tangible investments will soar in a second phase of the bull market. I have some explanations. I'm not sure that they're very good or comforting as to why gold is not hundreds of dollars higher right now than it is. We can probably go into that in the Q&A session if anyone has any questions, but a bit much to go into right now. It is important to note that rate hikes are good for gold. That's counterintuitive. People don't really think about that, but gold has typically outperformed following the first rate hike of a Fed tightening cycle. This comes from the World Gold Council. The first bar shows 1 year, the brown bar is gold. 1 year, gold performs okay. 6 months before the Fed rate hike, gold underperforms. But post-rate hike, 6 months and 1 year, gold outperforms everything else, the green bars being the U.S. stock market, the red bar being the U.S. dollar. Rate hikes are good for gold. Let's go back to the Fed's last campaign of rate hikes, post-December 2015. These red arrows, these are 9 red arrows that show 9 instances of Fed rate hikes post-2015 when they began hiking rates. Out of those 9 instances, gold rose in 7 of them. Gold is good, does well in rate hike cycles. Now, this is the bull run that the December 2015 hike, the initial quarter-point hike, sparked in gold. I'm proud to say the Gold Newsletter was, I think, the only letter out there, at least really publicly, saying that this will spark a new bull run in gold. And it did. Gold went up 30% over the following 8 months after the first rate hike right there. That 8-month spree in gold was very good for gold. Again, it went up 30%. But those companies out there, the junior mining companies, many of them went up 2, 3, 4, 5 times in price over that 8-month period. This is what I kind of expected to happen after the Fed's first rate hike. But to briefly cover that, I think that Russia's invasion of Ukraine put some noise in the signal, and then the Fed was much more determined in its tightening than people gave it credit for, and more credit to Powell and company for that. They are much more determined than the market gave them credit for, and I think that's created a bit of noise again in the signal that gold usually uses. So that would have been the first run, the first stage of the gold bull market. When the Fed is forced to retreat, that's going to be the big second run. And that's me. I cannot believe I ended early, doing my part to get us back on schedule. This rarely happens. I am Gold Newsletter, goldnewsletter.com. New Orleans Investment Conference this fall, October 12th to 15th. It's going to be a wonderful event. We've already got lots of registrations flowing in, and Exhibit Hall is getting close to selling out of a lot of sponsorships. So please come to New Orleans. Twitter, at Brien_Lundin. Follow me there for my latest views on the markets.